As we enter 2026, the charitable giving landscape has changed pretty dramatically when it comes to the tax credits that you receive for the charitable giving that you do. So, in today's video, we are going to break down the major changes that occurred from the One Big Beautiful Bill now that we're in 2026, as well as a number of the planning opportunities that are available. Welcome to Couple Bowl. My name is Michael Dunham. With me today is Patrick Fontana, the founder of Fontana Financial Planning. Welcome, Patrick.
Welcome, Michael. Cheers.
Cheers. So, Patrick, to kick us off, can you just break down for the viewers here at a high level the changes that went into place here in 2026 when it comes to charitable tax planning?
Absolutely. So I think you narrowed down kind of the top three things, and maybe you hit the three things, and I'll go into how it affects me as a business owner, good or bad.
Okay.
And if there's a workaround on how to make it more profitable. Also want to point out as you maybe zoom in the couple little updates that we'll continue to update on our set. We've got some more scenery, copy of the book, and some gift boxes, and we may get what do you call it? A tennis racket with a stencil on it back here, and just make it all cool. So let's hit the top three.
It's always looking better. Yeah. So number one, non-itemizers now have the ability to deduct their charitable giving up to certain limits. So historically, the way that it has worked is charitable giving has been an itemized tax deduction. The standard deduction is quite high. This year, it's over $32,000. And what that has meant historically is people that gave to charity did not receive any sort of tax benefit for doing so. Starting here in 2026, those individuals who take the standard deduction now have the ability to deduct up to $2,000 if you're married or $1,000 if you're single of charitable giving. And so if you are somebody that takes the standard deduction, historically where it's not made sense for you to keep track of the charitable donations that you've made, you're now going to get a tax benefit, and it'll make sense to keep track of those donations up to the 1,000 for single or 2,000 if you're married threshold.
So let's put a practical person on that. Say my folks who are older in their 80s taking qualified charitable distributions from their IRA for their bigger charitable things. And it's always frustrated me where my mom might forget to run it through us to do the charity and write a check for $100. In the past, that $100 just didn't benefit them. Where now, if she wrote $100 or 20 checks for $100, total of $2,000, that would put significant money back in their pocket to the tune of, a third, just an extra $500, say, in their pocket to do something with.
Yeah, exactly. And so that's a great example. You're at church and you decide to write a check and make a small donation, or walking into the grocery store and there's somebody raising money for a cause. Like historically, when it's been really hard to take advantage of those situations. If you're giving through your IRA as a qualified charitable distribution, it'll now make sense. Like you can still do that. Now you'll get a little bit of a tax benefit for doing so.
And we've told people in the past to kind of, in some cases, not worry about that. Like, if it's small checks, don't worry about it because you don't have to keep track. Now it's worth keeping track because you'll get your income tax bracket back on that amount of money up to $2,000.
Items number 2 and 3, I'm going to pair together, and they're both typically for individuals that are itemizing, although they don't necessarily have to be. So number 2 is there is now an AGI, which is an adjusted gross income hurdle that you have to eclipse before you start getting a tax benefit for your charitable gifts if they are itemized. So that hurdle is 0.5% of your adjusted gross income. So to put numbers to that, if you made $1 million this year and you gave to charity, the first $5,000, 0.5% of $1 million, you do not get a charitable tax benefit for. So if you gave $30,000 to charity, you get credit for $25,000 of that on your taxes because you have to eclipse the AGI hurdle of 0.5% or $5,000 before you receive a benefit. Item number 3 if you are in the 37% tax bracket, so that same example of the individual or family that made $1 million, you don't get a 37% tax break, which is the top tax bracket. You get a 35% tax break. So unfortunately, for individuals that are high income earners and make good money, you kind of have these two potential detractors from the tax benefit that you would receive compared to previous years on the itemized tax deduction side.
So to put a practical spin on that, as a business owner like we are, if you have the ability to do any of your charity through the business as a marketing expense, some of the causes that we support, that'd be one way to get a little bigger tax consideration. Another strategy would be, like, we do a lot of conversations about bunching, and particularly when there's a high income year followed by maybe a lower income year, this is more incentive to do that, kind of pushing your donations into the 1 year, so that once you're past that hurdle, you get advantage of all of that. And then with our foundation accounts, where we really front load charity, the money's already in the charity, so that you can continue doing those gifts from the foundation account once income is lower, and don't worry about that hurdle the next few years.
Yeah. So to break that down a little bit further, the concept of bunching, essentially what we're doing is we're taking future years' givings and we're bringing the deduction forward to one single year, so that we've already eclipsed the hurdle. So in this case, the $32,200 standard deduction is the first hurdle. And then the second hurdle is the AGI threshold. So on that $1 million income example, the $5,000 that we don't get credit for. So once we've eclipsed those two hurdles, now everything is pure deduction from that point in time, versus if we gave charity year by year by year, we have to eclipse those hurdles every single time. Now we're getting a bigger multi-year tax benefit by taking that future giving, bringing it forward to this year, and getting a bigger overall deduction this year than we would have gotten year by year by year over the next however many years. So that's part of the concept. The other part of the concept is when we do the gifting of appreciated stock instead of cash to these foundation accounts or donor advised funds, we also don't have to pay capital gains taxes on the growth of the investment. So if we bought Apple for $10,000, it's now worth $25,000, and we grant it to the foundation account, the $15,000 of growth, we don't have to pay taxes on when it goes into the foundation account. The foundation account is a tax exempt organization. They can sell it tax free, and then we can gift out to charity as we see fit from there.
So to give an example, I know a plan that Michael worked on this week where clients are mid 60s, right? 63, 65. They've got the plan to start doing their charity from the big pre-tax IRA once they're 70, but there's this 5-year, 7-year window before they can do that. And income's at an all-time high. They happen to have some highly appreciated stock, a couple positions that we bought for $5,000 that are worth $200,000. It's almost all gain. And what you laid out on that strategy session that I did this week was, here's one smart planning move. Take these positions, put them in the foundation account now while your income's at an all-time high. For the next 5 years, that money is invested and continue to be making grants and doing the charity, but they'll maximize the tax break part of it, and they'll bridge that gap until they can do their charity from the IRA.
So the other concept that I think may be worth hitting on that you've alluded to, and you just alluded to in that example, is what changes when you reach the age 70 and a half. So if you're watching this video and you're 70 and a half years of age or older, you have the unique ability to gift money out of your IRA account, and you get the tax break for doing so. It comes out tax free. So has to go to a 501c3 charity. But the cool thing is, it's a way to take money regardless of standard deduction, income, AGI thresholds, any of that. You get a pure dollar for dollar deduction in the sense that money comes out of a pre-tax IRA tax free and goes to charity. The additional benefit is once you reach the age of 73, right now,
for most folks,
deferred to 75 later. But once you reach that age, you're required to start taking money out. And what we see a lot of times is those required distributions become significantly more in some cases than what people actually need. And this is a way to get money out of your IRA in a much more tax efficient manner so that you check the box of reaching that required distribution amount that the government is forcing you to take.
Right. And I know you've done a lot of sharpening of the pencil to figure out, okay, how much does it make sense, kind of to do this? The charitable folks that have to take out RMDs, that's important to know that that counts towards your required distribution. And there's a limit on how much you can do, which it's gone up a little bit every year. It's in the $110,000 range.
And to get super nerdy, the money that comes out as a qualified charitable distribution is excluded from income. And what that means is it's not counted in your modified adjusted gross income when it comes time to determine your Medicare premiums. So it can save you money every month on your Medicare premiums as well. So super in the weeds there, but it can be a benefit, especially if you're doing some big charitable contributions. Patrick, I want to hit on one last topic when it comes to charity, and then I'll wrap us up, which is what is the best way to leave money to charity when you're gone?
Well, I don't know if you're trying to throw me a lob alley-oop easy one here, but when you have pre-tax IRA money, like a lot of us do, we did the right thing by maxing out our 401k all those years and getting a tax break. If it's worked out well and the investments have grown, we find ourselves with having a big chunk of pre-tax money that we owe taxes on no matter what. We went to a thing in Phoenix, tax nerding out with Michael, I call it, where they made this analogy of, running your enterprise, right? The Dunham family enterprise, your house and your investments and your everything. You have a silent business partner, and this business partner is not good because they can change the rules, change the tax rates, but that's the IRS, right? And so if we can buy them out as a business partner and not have them be a liability that we owe, that's good. That's the answer, is take the pre-tax IRA money that you are going to pay taxes on. And if you're older and you never kind of tap through that money, your kids are going to pay taxes on that. So we both dealt with a lot of planning with that, and that's the place to do it from.
Thanks so much for sticking with us and nerding out on charity today. Down below in the show notes, there is a link if you'd like to talk about your specific situation and how we might be able to help. We're happy to have an introductory phone call. So please feel free to schedule a time if you're so inclined. And Patrick, how do you want to wrap us up today?
I love our charitable goals and where we're going with that. So rebalance with big gainers to charity so you don't pay taxes on it or from your IRA.
And live abundantly.
Cheers, Michael.
Cheers.